Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters and Associates, as well as the Chief Investment Officer. As always, today I am joined by my fellow partner, Brian Bortz, who is the head of our investment committee, as well as Brad Sanders, the managing director of Tectonic Advisors. And this is your March monthly update. For the month of March, the S&P 500 was up 3.2%, global stocks up 3.1%, domestic bonds up 0.9%, and global bonds up 0.6%. And Brian, I want to come to you first on that S&P 500. Obviously, it was a good month for the S&P 500, but for the first time in a while, we saw that the equal weighted index, meaning if we weight each individual stock in the S&P 500 equally, was up 4.5% compared to the S&P cap weighted at 3.2. So we saw some outperformance there on the equal weighting. And then also small caps and mid caps were both up more than the S&P as well. So we've seen a little bit of maybe movement here on the whole Magnificent Seven front. And we're starting to see a little bit more performance, not just in those bigger names. You want to talk a little bit about what we're seeing internally on the investment committee, what we're talking about, and whether or not this sort of, temporary outperformance is sticky and will stick around for a while?
Yeah, thanks, Hunter. I mean, you hit the nail on the head there. One of the key things that we have said that we're looking for is more market breadth. When you look at what has been happening here over the last year plus, the quote Magnificent Seven, really now those are kind of down to two or three names, and really being driven by Nvidia and Meta at the top end. But we're starting to see a little bit of market breadth creep into the economy, which is great. Like you said, the equal weight outperformed the cap weight S&P 500. Small and mid caps outperformed the S&P 500. So all of those things point to a very broadening of the market, which is very, very good for stability and for overall market security. What we don't see is a clear picture forward, even though we're getting a little bit more market breadth. So I would say that one of the things that we want to look at going forward is how volatile are these changes. The Fed is clearly going to be the key player as we get closer to the summer. If they don't stick to their game plan, and if we don't end up hitting kind of what our expectations are, we're going to have a heck of a lot of volatility. And this recording is going to now then be very similar to what it was a year and a half ago, where all we talked about was volatility. But right now, things look really, really good. The economy's strong. The stock market's doing well. It's broadening out. And these are all good signs for what's happening right now.
Yeah, that's great. And Brian, you actually, commented, which I think is a good segue over to Brad, on the Fed. In the most recent meeting, obviously, they did not rate hike, but they're still indicating about 3 to 4 rate hikes as we near the end of the year. But Brad, I mean, that the amount of time they have is compressing. They're certainly, running out of time to do 3 to 4 this year, especially ahead of the election. You want to talk a little bit about what Tectonic is seeing and research on what the position the Fed is in as we sort of head towards the election, and whether or not they can get these 3 to 4 in, and then also the impact if they don't get those 3 to 4 in on what we think will occur in the markets.
Yeah, to piggyback on what Brian said, the market's basically priced for perfection here. And I'm not saying from a valuation standpoint, I'm talking about from an economic scenario. So when I started at Tectonic 15 years ago last month, you couldn't turn on the TV with it was March of 09, and everybody used the word green shoots of recovery, if everybody can remember that. And like that was just green shoots over and over. And you can kind of replace that today with soft landing. Everybody's just like, we're going to have a soft landing, and that's what the market's pricing in. The reality is quite different, though. So in the post-World War II era, the Fed's gone on, this is their 13th tightening cycle. They've only engineered a soft landing twice, once in the mid 60s and once in the mid 90s. So you can think of it, if you want to handicap it, like odds makers, it's like less than 1 in 5 chance you actually get a soft landing. And that's because they're real good with the data side, but you can't predict human behavior and you can't predict how things are going to happen. So all that being said, yes, the Fed's kind of running out of runway. They didn't cut in March. They're probably not going to be able to cut in May based on the economic data and where unemployment is and where inflation is. So you start getting into the summer, and they're talking about 3 or 4 rate cuts. I want to make it clear those are quarter point cuts. The Fed cannot be doing anything crazy like jacking rates down 0.5% or more at a time. With inflation where it is, it would be a disaster. So this is going to be baby steps. So when you're doing baby steps, if you don't do one going into the summer, if you don't do one, probably July is where we would target maybe the first one. And if you don't get that one, then you get into election season, and the Fed likes to remain apolitical, and they're not going to want to be cutting rates right before an election unless the economy necessitates it. So then you start talking about elections first week in November, and then you're kind of left with the December meeting. So we think the market's priced for perfection, meaning they've priced in 3 to 4 rate cuts. The Fed's reiterated that with their words. Let's see if they do it. Paul Lyons and I are kind of aligned that we think we'll get 1 to 2, and we won't get 3 to 4 this year. We'll see. I'll be shocked if we get more than 2. And then the soft landing side, it's just, could it happen? Yes. And that's what the market's pricing. When you see this broadening, the market's pricing, yeah, the really expensive stuff, their growth slowing down, they can't justify the multiples. We're going to pull our money out of that, but look at all this other stuff to buy, and it starts going there. The market will continue to do that if we continue to have a soft landing scenario. And if we get our third one in the last 75 years, we're probably going to be in for a pretty good ride. But any kind of move at the margin on either side of that, we're probably going to see some volatility. And I think it'll look a lot like what happened last summer and fall when you had the market price in post Silicon Valley Bank. They priced in at 2008 and rates went down a lot. Then you get in August and they're like, oh, it wasn't 2008. And you have to unwind all that and rates go back up and the markets drop. If we get something other than a soft landing, you're going to have to see all that pricing mechanism reverse for a few months, and it'll be really volatile. We would like to take advantage of that volatility, though. I think it'll be a really good buying opportunity.
Yeah, that's great. Thanks, Brad. And listeners, if you're interested in hearing even more detail, Brad does a weekly recording that expands a lot on all of the things that he's talking about here. So you can grab that from your planner. It's super helpful, and it's got a lot of great information that, again, sort of expands on what he's already talked about. So thanks as always for joining us, and we will be back in front of you at the end of April.